Legal disclaimer. Bespoke Group investment advisory services are offered only through Bespoke Advisory, an SEC-registered investment advisor. Everything we share here is just for information and education. It's not investment, legal, or tax advice. Bespoke does not offer or solicit investment services to the general public. And as always, investing comes with risk, including the possible loss of principal. Okay, so hello, Sune.
Hi, Claire. We meet again.
We meet again. Today, we are going to walk through the wealth advisory side of Bespoke Group. We're going to talk about what we do, why we do it the way we do, and how we serve our clients by really building around them. We exist in an industry, as you know, many know, we talk about, where many are still pushing products, and we very consciously at Bespoke take a different approach, which is what I'm excited to talk to you about today. An approach where an approach that is holistic, independent, and grounded in long-term outcomes. So that's the lens for today's chat. I'm joined by Sune Hojgaard-Sorensen, our managing director of Bespoke Advisory, who's going to help unpack all of this.
I thought you covered it all right there in the intro, so we might be done.
All right, that's a wrap.
No, it's it's an interesting space to start off, I think, because I think there's some key pieces that we need to lay down as kind of the grounding for the conversation. Because I think when people hear that we do when I do hear that we do investment management, they often come with the assumption of kind of the standard approach to it, and so I think the conversation generally tends to shift to a different direction once we start outlining kind of what it is we actually solve for. And as you outlined, we build around our clients. And so our clients are generationally wealthy clients. And so it changes how you think about the word investment and the activities that comes with it. One is just the longevity of it. You have much longer time horizon. And when we first started building our Bespoke Advisory, I've spent a long time in the industry, both on kind of more the product side. But when we started building our Bespoke Advisory, we were asking ourselves these questions about, what is it that we truly solve for? What is the value add in what we do? And who are the people we serve? And then we started with one person or one family and really started building around them. And then obviously there were some commonalities that then translated to the second one. But mostly, you have to come at it almost like a unique project every time we take on a client family. And so the first one that we do have in common is if we do our jobs correctly, then they will have wealth beyond the principal's life and potentially into second, third, fourth generations. And so you get this much longer time horizon where what seems to be important, and if you switch on financial news, which I generally avoid completely, is kind of what's happened the last 3 months and what might happen, next week or 3 months from now. Those things are not super relevant to the types of clients that we serve in terms of how you think about the wealth. And I think the other piece to it is, we find clients where they are. And that means if they have generational wealth, it's very rare that will be sitting in cash. I just sold my company. In most cases, it comes with a collection of existing assets, sometimes a business they build, other things. And so you got to start with that. You don't get to start just with, I have X amount of dollars that I want you to do something with. And I think those are the two differences, is really you find the client where they are, and that's a different place than most people because they've achieved something extraordinary in some way or the other. And then the different thing is that when you're starting to think forward, you're not thinking quarter or 6 months or 12 months, you're thinking 12 years, 20 years, even beyond that. And if you're thinking about the philanthropic side of a family's wealth often.
So before we get into the assets, actually, there's something interesting, right? It's like you meet the client where they are, and every client's experience is different, so it's going to look different. Hence our name, Bespoke. It's very a tailored approach, but there are some pillars that I think that are, how do you say, that apply throughout. And so maybe we can look at those. You highlighted a long-term horizon, which is unique because I think long-term typically in industry will be like 6 months, and what we would consider short-term. But and then there's a global approach utilizing other jurisdictions and currencies. I think some other pillars just to kind of set the stage of the conversation is resilience. Feel free to chime in on those.
Yeah. I think, again, the starting point for me would be that in truth, we're generally risk managers first, because the client has already done the hard part, which is they build generational wealth, which is, again, an extraordinary outcome just statistically. And so my job is not to go out and load up on risk or build some kind of standard portfolio. It is essentially to say, well done. Generally, when the client comes to us, if they're looking for asset management services, they're looking for something beyond. They're looking for someone to hand off to if they want to be spending their time doing other things. And so my starting point is risk, and then obviously opportunity. And I think when we talk about risk, which I think is important to define, and again, something we focused on initially when we started building out the solutions, I think people my industry associate risk with volatilities. Oh, the price went up 5%, it went down, 10%. Those are risk if you have short time horizons. So if you're leveraged because you're trading alongside those things, you're a trader, not an investor in my mind. We are investors first. And so for me, volatility of price is actually opportunity, because I can buy when others are fearful, to use a very common sort of theme, which again sounds easy, much more difficult to do, and to do it consistently over decades takes, a rules-based approach and sometimes getting a little lucky here and there. But so volatility is not our risk, so to speak. It's maybe our opportunity in some ways. What is a risk is permanent loss of wealth, and that can take the form of actual realized loss. It can take the form of debasement or lack of loss of purchasing power. So the currency component, which we can talk a little bit about. And then, other aspects, which I think is probably covered in some of our wonderful series of podcasts that focus more on the how to own, the where to own, where the primary risk of permanent loss of wealth for a generational family at least needs to be guarded against in that space before you even get to the assets. And so we think about risk in that context first. And then from the investment side, the kind of stuff that takes away generational wealth in big chunks. One is the negative compounding of the debasement of the currency. So we think about that, and we can spend some time on that. And the other pieces, we tend to look top down at two aspects. One being geopolitics. And by geopolitics, most actions in geopolitics, and we live in a very rich vein of noise in the geopolitical area right now, but most of it doesn't actually truly have any lasting impact on markets. It may have big swings because people get emotional about it in the short term. But in most cases, if you track back, in most cases, the best thing you could have done was probably buy the things you liked at those times and, hold on to what you had. Geopolitics is really translatable into two things from a risk perspective. One is currency. And so again, we can have big swings in short spaces, and sometimes they remain big swings downwards and they continue in that journey. And so it can be an inflection point for a currency versus other currencies or versus hard assets. The other one is just this more sort of common aspect, which is a gradual debasement of the currency. And so we deal with that. Geopolitics can also, specifically if you invest in emerging markets, it can lead to a lack of rule of law. And so you could have a loss through confiscation, etc., which, to be honest, is also increasingly a risk in developed markets where there's a soak the wealthy type mentality. And we're seeing what I would say is overreach in certain areas of how you tax, how you punish, how someone should think about the ownership of their assets in that environment. The other big one that can destroy and create wealth in equal measure is technology trends or innovation trends. Creative destruction is very real. If you, again, thinking long time horizons, if you look at the top companies 30 years ago, 20 years ago, and 10 years ago, they're not the same companies in most cases. And so that's because businesses change. And so that's also the wealth creation that generally leads to a generational wealth is, building a business in the right industry at the right time and harnessing some kind of growth in technology. But when we start, it's obviously the question we ask ourselves is, are we sitting on the right side of geopolitical trends as we see them now and in the next decade? Same question around the technology trends. Is this portfolio geared for yesteryear or is it geared for the future? And that's kind of the top down on the risk side. And obviously it's a double-edged sword. So what is risk in this case can also be opportunity. So again, sitting in the harder currencies, sitting in real assets can be that counter and potential profit-making tool for the geopolitical risk. And same with being on the right side of long-term technology trends can be a real wealth creation opportunity.
So do you want to introduce you mentioned geopolitics, you mentioned being ahead of kind of or looking forward to the technology, the future of technology. Can you highlight Bespoke's deep research capabilities that support this? in action?
Yeah, I think, again, our actual application of this is obviously for our clients. And so we are not here to sell something on CNBC. So no one should be taking notes and take this as investment advice. But, again, I'll start where it all began, which is when we started building Bespoke Advisory. And so obviously, once you realize that these are the risks you're managing and the opportunities you're trying to harness, it makes sense that you should be building a research team, research capacity to try and understand and ideally have informed opinions around what is the future, and no one has a crystal ball. But when we started building the team, I was very much thinking I need very smart people who understand technology and very smart people who understand geopolitics. And we need to create an environment where we can think differently about these aspects, because if everyone agrees, then there's no opportunity. And so it's for us to put together these thoughts, which often means understanding across industries, across geographies, what's really taking place. And that's just a starting point, because once you kind of have the big picture idea of we want to be in robotics because we feel automation is leaning in, and there'll be certain catalysts we could see across different areas of it in technology that might make this a real interesting area to be in terms of kind of a general purpose technology being unleashed in key industries. Well, that's cool, but what are you investing in? Because there's not like one thing you can buy now. Wall Street and financial industry will sell you some kind of product which supposedly captures AI is the popular thing right now, but how do you actually invest? And so that's where the second piece to our research came in. We realized we have to do the work. We are active managers over long time horizons. And so we have to do the work. You have to truly do fundamental work on the companies. We take an ownership mentality, which by that I mean, I'm not here to speculate. I'm not here to try and, figure out the market. I'm here to try to figure out what is good business in now and in the future. And within good business, there are many ingredients to that. And we have some thoughts on what that looks like at a company level, whether it's a private company or a public company. And then it's really about building understanding and building conviction about what you understand to be true, because you're never going to have perfect information. And so in this case, you're making decisions with imperfect information based on probabilities. And the more informed you are on those probabilities of outcomes, generally you're gonna have better and better outcomes over time with that type of approach. And that's really what we've been building around, is basically understanding those three pieces, the two big top-down trends, and then to be able to actually do the work on the areas we think is interesting.
Okay, that's what I was going to ask you. Is you said the top down. Can you put that in simpler terms for me? What you really mean by
Sure.
that?
Top down is where we started. So my general start would be geopolitics, which is a fancy word in some ways, but it's kind of, well, how do we think about that? It's kind of which geographies, which currencies do we want to be in, and which one do we not want to be in? And so that's the big picture. Now, let's say I'm excluding X amount of countries. Now, instead of my analyst team at the bottom up side having to literally analyze every single company in the world, we now can take half of the world away. And
Oh,
now we have, let's say, Switzerland, Japan, Singapore, the US, Korea, whatever it might be.
okay. So it's flipping it on its head. It's going macro to micro.
Exactly. I want to, I think, again, you can only know so many things in this world. And most times you're probably going to be wrong anyway, or at least directionally you can be right. But in like the specific application, you're going to be wanting to have some room for error built into your thinking and your allocation. And so we generally what I always start with is like, why shouldn't we do this thing? Again, back to what is my premise. I'm not here to make someone wealthy overnight. I'm here to protect what someone spent 30 years of their life building. And so my starting point is, let's get rid of what we have pretty high conviction is not a good place to be from a currency, from a market, from a rule of law perspective. And then the same with technology overlays. Where don't I really want to be doing and spending my time? Just because until the facts change as I see them, these are not areas that are going to be conductive for the returns that I'm seeking or the income I'm trying to generate. And now I got a smaller pool to think about. And then I can unleash the people who are now actually going to do bottom-up work, i.e. take those companies apart, understand their technology, their moat, their IP, their balance sheet. And so that's kind of the approach to it.
Okay. Another question about our approach is, and I'll need your help kind of shaping this, but I've been thinking about how when it comes to wealth management or asset management, you hear about philanthropy and you hear about giving it all away. And then you hear about investing, which is like getting as much growth as possible. But I think that there is this interesting space in between that isn't maybe is explored less often. And that's kind of what comes to mind when I hear about our work. Am I getting that right? Do you see that it's kind of like this middle area where there's, where you are still generating income and return, but it's not like growth for growth's sake. Maybe you can
Yeah.
slot in here.
Yeah, because I think it starts again back at the client where we find the client, and each client that we have, and most that I come across, have some personal values. And as a family, they have values. And so when we talk about finding where our client starts and trying to basically start by seeking out to understand, yes, we can understand we need X amount of cash flow. We need, to protect what we created, et cetera, which is more, those are metrics you can map out. That's not super complicated. But often what is a little bit more complicated is two things. One is family and the other one is kind of values. And family really involves next generation, any dynamics within the family, what might stop them from making good decisions, and how can you help them make informed decisions, and maybe balance some of their intuitions. Often if you build wealth, significant wealth, you might have been a risk taker, and so you might kind of have that same mentality, and sometimes you try and offset that with what we do is to balance, decision making. But what you asked me about is really more the value space. And so again, getting to know someone, you get to understand them. Some have very formed ideas, and there's sort of a whole industry built around what is unfortunately kind of labeled as ESG, et cetera, which I think is, again, like anything, it can be taken, turned into a product, and it has been. But that's not what we do. I think for our clients, it's really more about, are there some things you don't particularly want your money to be building around? And on the flip side, are there some things you do want to support? And often our clients are entrepreneurial, so they've seen the power of putting capital to work in certain areas, maybe to support certain innovation. And so they want to do more of that. It's not like a trade-off. So I think to the first point, I think there is a general assumption that you can't have impact investing or a values-based lens and also have optimized returns. I think that that's flawed. I think that's just lazy thinking. I think if you do as an asset manager lean into that, you can find ways to have above
Yeah,
average returns
it takes
and still capture
creativity.
values. 100%. And there's, every lens you add to a portfolio is extra work, but it's the work you get paid for in my profession or where we sit. And so we lean into that. And that does mean that that's probably where it's most different. So like when we talk about the technology trend and the geopolitics and the bottom-up work, while that will be different to each client, it's kind of the same exercise. But when the values lens gets laid in, then the Rubik's Cube gets some more layers. And now suddenly we are trying to figure out how do we then get this across while still kind of staying around our core risk principles.
Yeah, it's a challenge to incorporate all of those layers. It becomes a bit of a puzzle to solve and serious creativity that's required. So it kind of makes sense to me why, you know, uh, it's not an easy plug and play. It takes a lot of creativity.
Yeah, for me personally, this is what I enjoy. Again, if it's all solved and, then why bother? This
Yeah.
constant puzzle was what attracted me to the industry in the first place. And I think many people who find the industry thinks that that's what they're going to be doing. I think you're very fortunate if you actually end up in a job where you're somewhat unconstrained and you actually get to do that work, because unfortunately, the way the financial industry is very siloed, many young people end up, specifically when they start in the industry, just doing something super narrow, and it often gets turned into a product that then gets sold. And they're so distant, they're at such distance from the end investor that you don't really get to have that. We are like the complete opposite of that. I literally sit on the same side of the table as this family. I get to hear their stories, their ups and downs, and understand how they got there. And you take that as an added responsibility, and to be honest, to be trusted with something like that. I think that's pretty powerful. That makes you want to do your job very well. And I think then the fact that you get to do interesting work across assets globally, you get to learn from extraordinary people in terms of their entrepreneurial background often. So, for me, it's good. I don't think it's for everyone. And I think, again, if you were to build an optimized business in the investment space, it's certainly not the short-term most profitable business to do what we are doing. It does take a lot of work, but generally it leads to long-term relationships with a lot of value that is maybe not just about 1% up this last quarter or 2% down.
Yeah, but I find it really exciting, this coming together of creativity and then like what was typically a really rigid kind of world. Anyway, so okay, so you said something that was sitting on the same side as the client and you've talked around, you've painted the picture of the type of work and the approach to the work that you're doing with these clients. But I was wondering if you could just describe how you see your role, because you're really guiding clients through these informed asset decisions across asset classes, and it's super client centric, right? Like no client is the same with their assets or their circumstances, their challenges, their family dynamics, their hopes, their dreams, maybe they want to simplify their life. Maybe they want to, buy land and start a tree farm. Like, I don't know. So, you're
Yeah.
in this really interesting role. Can you describe that for me?
Yeah. And again, I think we should, to kind of show, I think, probably the scope of the work. So obviously we have an investment team. While I insist that they are very engaged with clients and participate, they're primarily doing bottom-up work or doing research and getting into those types of things. And then we got the client-facing team, and I sit and straddle both because they primarily sit within Bespoke Advisory. And so my role with our families is generally one of an advisor, and that means I sit with the clients, um, when things are being designed and built, and when we seek to understand, there's a lot of time spent there. Then we're implementing, and then the investment team gets on with the work within the blueprint, and then we are there in that client's corner, whether we sit on the investment committee or some less formal framework for it. But we are there then with them on this journey into the future. And ideally, we help them make informed decisions along the way. And if they entrust us to manage the wealth, ideally we do a good job at that in terms of being primary decision maker across the total assets. And so that's a different role. It is a role that involves, as I said, both being a trusted advisor. And again, some of our clients have active business interests, or have maybe given most of their wealth into philanthropy. Actually, that was one thing I wanted to kind of add to that. When you have generational wealth, you're never really giving the money away. It doesn't disappear. It either gets put into a vehicle that's going to be doing some kind of philanthropy. So whether it's a foundation that supports a specific, a museum or a university or hospital or some other activity, or whether you are kind of putting into a charitable vehicle and then over time doing continuous giving from there. We manage those types of structures, whether it's donor advised funds, whether it's foundations, or whether it's endowments. And it's kind of the same thing. So within that concept, the money may be moved away from the personal use of first generation or second generation, but it's either placed with a third-party foundation or philanthropic institution, or it resides within the philanthropic vehicle of the family. And then we have the same mandate to manage those assets. It's a little different because generally you're tax exempt in there, so you can make a little bit different decisions. But again, for most of our clients, they want the same approach. Protect what is here. It's even more important because this is something that's really supporting the community, the stewardship I want to have maybe for generations. And the second thing is they're like, why should I be giving to, let's say, something in the healthcare space, and then you go and invest in cigarettes or like something that's damaging to health? No, I want the same impact, the same lens to be applied within my philanthropy vehicles. And so we build and run portfolio like that within the actual part that is doing the giving. And so I think that that's an important thing. There's no just hand it all off. I mean, you could do, but then if you're handing it off to a charity, that charity has an investment manager and they're doing something with that money until they actually go out and put it to use in their specific field. And so I think that's an important nuance around some of the work we do at that side.
I want to spend a moment. You mentioned philanthropy on this. This is not the philanthropy episode. You can find that in the collection. But, again, it's all related. It's all connected. And I think, when I asked you about your role and you highlighted kind of the advisor's position sitting on the same side, and then, the investment team that is doing the bottom up work. But when we're talking about this level of wealth and like the scale of the projects that we're talking about reflect the level of that wealth, right? Like lots of money, lots of needs, lots of resources. And I'd love to hear you talk about, we don't need to get deep into the weeds or the specifics of the most recent adventure to far corners of the world that you went on. But I think that it is, I would love to highlight the lengths that you and our team go to make sure that this capital is deployed in the way like that it has the intended impact. And impact has become such a, I would say, empty, frivolous, like almost dirty word. I notice as I'm, when I'm in the world and I'm speaking to investors and I ask them about impact, and it's empty. Like people don't even believe, like, it got a bad rep probably because bad decisions were made and there was a lot of lack of creativity and it was a product to sell. But I'm on the ground floor of witnessing actual authentic impact, and there's impact whether you want it or not. There's good impact, there's bad impact, impact's happening regardless. Anyway, so this is kind of a quick moment to shine the light on what impact looks like at Bespoke and the lengths that we go to build for that level of wealth.
Yeah, I think you hit on something really important. There's impact. It's like risk. Risk doesn't go away. You can move it around and ideally you know where it goes. But the impact is always there. And so the question is just, are we intentional and directional about it, or are we not? And then what does that look like? And again, back to, that might be fine that we identify that the client feels that, agriculture has gone the wrong direction and we're not putting healthy food in front of people themselves, their family, their community. Or, healthcare is not available to the people who need it the most. Or, we have this range of diseases and no one is solving, and I want to step into that or at least be part of the solution. And then, that's a big idea, is a big concept, that's a big impact. And then there's like, okay, well, actually my job and our team's job is to then sit down and say, actually, tomorrow, this is what we're going to be focusing our research on. This is what we're going to try and find investable concepts around. These are then the managers. These are the companies. This is the credit. These are the different opportunities we're going to be allocating to. Now we've got to understand them and really do the work on it. And again, so back to the work, there's no hiding from that. There's no easy solution, because the easy solution is the product sales. That essentially is an empty shell with a nice brochure website. And our clients are not interested in those things. And so, so it starts with all of that work. And again, it's obviously different for each of them. I think some of the areas where, I think some of the interesting areas to highlight is that there are obvious areas, for example, within our investment themes around innovation, where innovation in the right industries can obviously change things dramatically for the better, and specifically around things like healthcare, education. You can just look at kind of longevity of life, quality of life for the broader humanity over the last, call it 100 years. And you can go and look at different companies, different innovators, different IP that was created and that solved some problems that, philanthropy can be great for firefighting, but if you're long-term going to have a lasting impact on big problems, generally it's some combination of some form of government and some form of innovation, and then smart people at the entrepreneurial level who's figuring out how to use some of those elements of government support or flexibility around certain areas at various times of history, then combined with some kind of IP that may have come out of government, out of university, or out of an entrepreneur themselves. And so that's pretty powerful. That's kind of interesting to think about. And then it's like, how can I identify more of those that are related to what the client wants? And so a lot of the work goes that direction. There's areas that are sort of low-hanging fruit, but there's also sometimes, we had a client where she's super focused around inequality and things like human trafficking. I mean, a lot of her philanthropy is focused around those. And so when she first came and said, look, I've seen significant amount of wealth here, and I'm really, I want to continue to be giving, so I do want you to manage my wealth effectively, but I want this lens on it, all of it. And at first, it's kind of like one of those where, well, this is a pretty niche area in terms of, at least that was my assumption when I started, lazy assumption to be honest, that it was going to be a very narrow space and it was going to be difficult to allocate without taking a crazy amount of risk or being very concentrated. And then we spent some time. I think you've done some another in our wonderful series with Ali, who leads really the impact side with me with Bespoke Advisory. But we spent some time. How can we be honest with this woman? At first, I was like, maybe we have to tell her that this is not actually, we can't do hundreds of millions of dollars like at any time range that it looks feasible to her in terms of her mission. And then the more time we spent on it, we started thinking, as it often is with any investing, it's not the obvious, it's the second, third order effect of some of these things that are actually much more interesting, whether it's from an investment perspective or from an impact perspective. And so when we started exploring it, we actually started finding more and more ideas, and one idea led to another. And a lot of the time it was just going out, having conversations, and then learning about how other people thought about different things. And at the end, we're still we still build a portfolio where we have various, what we call shades of different types of green, and the darkest green is the pure impact. And then we kind of work our way from, but we've gone from a portfolio that was I think 2% when she first came to us that we would at least describe as being aligned with her values, to flipping that all the way around, the other way around. But obviously a big chunk of that is what we would call lighter green, so traceable impact, but not as effective as some of the direct stuff we've done. And so I thought that was a really interesting journey. It was kind of, for me, an eye-opener of what's possible if we actually spent the time. And so that would be kind of one I would flag really more, because I think that was where I was first questioning whether we would be able to truly have impact without kind of being wishy-washy around some of the implementation ideas. So it is possible, but it does take work, creativity, and again, it's not done overnight. It's obviously it's a process.
Yeah, and I think what we're talking about in this level of creativity can also be, overwhelming for somebody who's like, "Wait, I'm trying to simplify my life." So how do you respond to that?
I think it's where the advisory role often comes in, to be honest. I think, again, it's very different to manage your own wealth and to manage someone else's wealth. And it just is. There's an emotional attachment to what money can create for you, you and your family. And it doesn't not necessarily negative. I think sometimes it can really make you focused and, drive people to incredible strength and length of commitment to something. But I do find that sometimes it's easier to get more emotional and to have reactions to things. And I think when I'm managing wealth, with some experience at the States, and the team, it is more balanced. It's more thoughtful. There's a plan. There's some rules based how we think about certain components of the activities we do, and we stick to those unless there's like dramatic differences in where we started those walks into the future. And then there's just, I think, specifically around some of these things where sometimes the reaction is the reaction, and then it's whether you can not pull the trigger when you feel the reaction. And often my job with a client is, let's not pull the trigger until we're 100% on this. Or at least we have really high conviction that we've seen significant shift. And I think sometimes the value in my job, when I think back over decades, is often the things we don't do versus the things we did do. Because the things we don't do sometimes is the role of the gatekeeper. So if you're a wealthy person and the world knows that, then you will have no end of opportunities of people coming to you with things. And sometimes that can be very tempting, specifically early on, or if it's people you think you can trust. But most of the cases, it's what you don't do in some of those it sounds too good to be true type opportunities. It's one of the risks that I would have with generational level wealth is either use a lot of leverage, or you, for some moment of weakness, lean into something that is too good to be true. And often I sit in that, let's do the work and why is it too good to be true type conversation. But then sometimes you are having to manage expectations with a client who really wants to do something. And that is sometimes the value add, I would say, in the relationship. It's not always well liked because no one likes to be told no, or like, I found some issues with something you thought were great, and now we're going to have to talk about it. And again, at the end of the day, the client made this well if I'm there to advise. But I would say a lot of the time, there is a value add to making sure we are making good decisions consistently, or we have a framework for making decisions and then sticking to it.
Yeah, and I think it's a great signal to highlight that Bespoke isn't selling specific products, so you can kind of trust more
Oh,
where the guidance.
you could never do this job if I had a product to sell, because then I am the problem in that mix. You see what I mean? So that
Right.
can never be, you can certainly have some preconceived ideas about, a specific currency or real assets or things that you feel right now this decade is going to be nice to hold. But there can be no product, because the moment that I have that, then my incentive starts shifting. And I like to say, when I analyze different businesses or different opportunities, show me the incentives and I'll show you the likely outcomes over a period of time. And if my incentives are not aligned with the client, it's just, I'm a human being. You will start making decisions to start looking better and better, whatever it is that you have that is more profitable for you to present to a client. And again, nothing wrong with that, but at least be clear. If you are actually selling a product, you can be an advisor on that product or that firm that creates this product. And you can advise them, just like you go to a clothing store and someone says, can I help you, show you around? Well, you may step into a financial services business and the person calling themselves an advisor is an advisor on that product that is way within their wonderful shelves, in their, beautiful offices. But they're not your advisor. Your advisor works with you, for you. and they're sitting on the same side of the table. And again, when I speak to our team, this is one of the key things when someone new comes to us, specifically if they have financial industry experience, is there is a culture shift, there is a mentality shift where you are the gatekeeper now. You are the person that are with the client, not here to promote some kind of offering for profit in the short term.
Yeah, so let's continue to compare and contrast, I think, our work a bit to the kind of existing services and advisory offerings that exist. I mean, one is that we're not selling a product. We talked about what a long-term horizon looks like to us and how that's our focus. I think we touched lightly on, how we treat our clients as direct owners of the companies we invest in. Maybe there's something else to add there, or any other kind of clients and their unmet needs, I think, is the way I would describe it, because that's essentially what's happening when people are coming to you or, in our team.
I would say there's a couple of things that makes us different. And, again, a lot of this here is not like, there's nothing, as the old saying goes, there's nothing new under the sun in financial services, and so we are certainly not like, we haven't rediscovered some incredible truth. I think we're just very good at a few things. And I think we're very good for the types of clients who are looking for solutions and advice and who want to build long-term, who want to be stewards of their capital. And there's great other financial services companies that will do other things. That will be, 2 and 20 model, who will take a lot of risk, will be super smart, laser focused on some narrow area. And they're a tool in the toolbox for total wealth, but they're not managing total wealth. And we manage total wealth in most cases. So the things I would say that is different, one is a fundamental belief that I've learned over the years, which is I favor liquidity over illiquidity. And what I mean by that is you have this toolbox and some of the tools within that. So in the financial toolbox, as I like to call it, there are really kind of three things. One is equity, one is credit, and one is real assets. And then there's different types of markets you can participate in those tools. Well, some are public, some are private. Public, again, you got to understand each of those public markets that you play in. Some do have very deep liquidity, meaning you could sell at scale without dropping the market onto yourself, and vice versa when you're buying. Others have thin liquidity, but there is the ability to transact in a public price discovery space when you want to participate in the market. I favor those markets first because of the price discovery, because of the liquidity, because my main job is risk management. And it's very hard to manage risk if you can't move, specifically if you're thinking decade plus long time horizons. That's counterintuitive because most people who are in my space, they push illiquidity. There's been this belief that there is an illiquidity premium to be had. It was almost granted as like gravity. It's like a universal law of some kind. It just must be. If I can't take my money out, there must be a premium attached to it. And I think many people, unfortunately, are finding out now that that is not the case, perhaps the opposite. And it started out in a good place, as most things in finance does. The idea that I went to a guy who had a lot of forest land in New Zealand and I said, we want to participate in this with you as an owner. And he said, well, you're not going to get out. These trees grow very slow, but I'll give you a little bit of a discount on valuation because of that. And so I'll say, cool, I got decades, so let's put some money with you. And because I was giving a better price of entry, because he recognized and I recognized that this was not going to be something that we were going to, leave next quarter when I had some other great idea. And over the next 20 years, we see beautiful trees grow. And, because I had my discount, I had a premium that I exited. Those days are gone in most things in private market, in my opinion. And unfortunately, what took its place from my good friend with the farmland or the forestry land in New Zealand, people who are asset gatherers, people who are building, AUA, AUM, specifically with sort of profit participation in their model, they came in and said, cool, you should be in venture, you should be in private equity, or you should be in some kind of infrastructure product that we manage for you. And we will charge you 2% and 20% on profit or whatever the split is. And the problem with that model is back to the incentives. So think of that. Now I give you millions of dollars for 10 years and you decide whether 10 years is actually how long, because you can probably extend it if you don't read the fine print in your PPMs. So now I'm locked in. You're taking 2% every year out of it in cash money. I'm getting paper statement that shows up and to the right because we are not having a liquid price discovery market where I can actually have transparency and visibility. That's a pretty good business. I don't have no clients leaving me because they've agreed to not leave for 10 years. I get to take 2% of their money no matter what really happens. I get to send them statements that, at least on paper and level 3 accounting, which essentially is put my finger in the air and it feels like the wind is coming in from the east, so the price must be going up, type accounting in my book. And so unfortunately, I think a lot of people are pushing this illiquidity premium because it was a great business model for financial services. Because if you're leaving your clients, if you have confidence in your ideas, you leave your client 100% liquidity. If you're not delivering value, the client will move. But when you do this other model, they can't move. And so for me,
Wow.
if I'm building an idea, I start with liquidity. And so that's always, so again, that's not to kind of, but I think it's a problem right now. I think many families that come across, in the last couple of years have gone 30, 40% illiquids and they can't get out. And most of the work I've been doing in illiquids, yeah. So most of the work I've been doing in illiquids in the last couple of years is trying to renegotiate, reposition, create value, sometimes create the tax loss harvesting that we can do by actually getting some resolution to some of these malinvestments. Because I think that there has been a tendency to push these products, both in the family office space, but also increase significantly in the endowment space, where again, it was the endowment model was to overweigh into illiquidity. And it worked for a while when they were going to my friend in New Zealand to be participating in his farm, his forestry, but less so when you started playing around with leveraged sort of acquisitions of companies in private equity or whatever it might have been. And so I think we have some issues in this space. But take that aside, I think that that's a sign of where we are in that cycle. Just as a principle, if I can find, so back to our idea generation, if I can find the geographies and the technology trends, and now we're going to be looking at allocation opportunities, my question will always be, can we harness these ideas through public markets where I can be liquid, so I can be wrong, I can get out, something changes, I can get out, the family's circumstances may change, we can get out. So it's always, can I get out? Because when you make, there's kind of two sets of decisions you can make. One is a one-door decision and the other one is a two-way door decision. And at least in a liquid allocation is a 10-year long one-way door where you hopefully can get back out through it. And so it shouldn't just be taken willy-nilly, that decision that now I'm going to lock away a certain amount of my capital, because I may never be able to come back through that door. I may be able to come back through that door with only very little in my pocket, and I definitely have to wait a long time. Whereas if I can get a two-way door, then I'm kind of like, okay, we went there for a couple of years. It was wonderful. Something changed in technology, something changed I hadn't thought about in geopolitics, something changed within what the family sets as expectations. Well, let's go back out that door. And so our first starting point is always, can we do these? How many ways can we harness these ideas through liquid public markets? Now, sometimes you do run into tip of the spear innovation, particularly, or real assets, where you can't really truly harness it. You can get close in some areas, but often a lot of the really good early stage innovation, if that's something you want to capture, you are going to have to go private market, early stage startup. And nothing wrong with that, but it should be sized appropriately. And again, you should be understanding you're making a decision where you're giving up control, or at least the ability to have optionality to leave. And that's part of then the decision making. And so for me, the liquidity thing is a major difference, because I think most specifically, supposedly sophisticated wealth managers have and continue to lean to private credit, to private equity, to private venture, whereas we tend to lean towards public markets. So that would be one.
There's two things I want to pull. That would be one. There's two things I want to pull on here. One is I couldn't help but think to myself as I was listening to you, wow, these families and individuals who are coming to you must have serious trust issues. And I truly can't blame them. But the other piece that I wanted to say is that you're receiving a lot of kind of like fixer. I mean, I'm hearing fixer up. Like, it's like you're getting these portfolios and then you're, going on a fixer up mission. I'd love to hear you talk about those two things.
Sometimes it's a journey for the client. Again, some clients have some awareness of this, or they literally run into it, and that's why they're leaving their current asset manager and looking for someone else. And that's often when I meet them, or at least they're curious about something different. And often, maybe whether they have admitted it fully or not, there is obviously often, again, it does happen that a client just sold a company and like, I will cash and let me go and find someone to work with. But in most cases, they already work with some advisors, and we have very productive relationships where there is a set of advisors. And again, I'm not tarnishing everyone here. There are great private equity, great venture, great real asset managers out there, and we work with a lot of them in a symphony for a client, if you like. But yeah, most of them come because there's a stone in the shoe, and maybe they have identified it, maybe they're just feeling the pain, and then often my first conversations are really, well, that looks like a pretty big stone in that shoe there. Maybe we should get that out of the shoe. And so then it becomes like a journey of realization and conversations about how can we deal with this, how do we end up here, and then how do we build something better going forward? How do we start gradually changing away? Because again, as I said, sometimes I inherit like all of those positions because we can't get out. And so it's like I may be managing those investments longer than the initial manager did because we're going to have to build an exit out of it in some way. And so that, personally, I don't enjoy the fact that my client is in that situation, but I enjoy the puzzle of that journey sometimes. I think it's
Yeah, it's an
interesting.
opportunity.
You can turn some of it around, but it does take like creativity and very different thinking maybe than how you went into those investments initially. And so that would kind of be my piece about the understanding of this, and how you start these conversations and often this journey, which is, again, as I said, we spend a lot of time in the intake to understand what is it you own. I would also just highlight, like, they also come with amazing assets because that's why they have generational wealth. And so many of them have built an incredible business and they still have interest in that one. And I learn a lot that I can then apply maybe to some of the other stuff from those types of clients. And we have clients, for example, who very young, got very curious about things like Bitcoin and bought a lot of it and held on to it. And so again, incredible asset that they bought at like below $10 or whatever they mined it. And so, it's not all, that's a different type of illiquid because of the capital gains outcome if you were to liquidate that. But that's kind of the good problem to have. Again, it's a liquid asset, which I like. And so that's just a little bit on the kind of the asset mix piece and how that starts.
Okay. Did that hit the fixer-upper piece, do you think?
Yeah, I think there's with everything, there's some fixing up, even within our own portfolios, just in the context that time moves, and there's kind of like, what are we looking at here? And we are always kind of challenging, is the right place to be?
Yeah, taking the stone out of the shoe. Okay, so now let's get into currencies. I think, Bespoke views currencies as its own asset class. Did I get that right? Is that safe to say? Might be a stretch.
No, I think that's absolutely 100% correct.
Yeah, so I want to hear from you what our house view is, and specifically, maybe you can introduce our views on the Swiss franc, Singapore dollar, and anything else you might want to add.
Yeah, and that is a good segue because that was be my other point, which is the liquidity versus liquidity question. I think is a major differentiator in what we do. The other one is we think globally in terms of, like, when I'm looking for investable, how do we harness these ideas? I don't just look at one geography. As I said, actually, geography is one of my first risk metrics. And so, I think it's inherent in everywhere you go. Like, people tend to invest mostly in their home markets and specifically in the US. And so many clients come to us and they have literally not an asset that is not denominated in US dollars. And so they have a 100% long US dollar structuring as a default, and not in a thoughtful way, just because that's how other managers tend to focus. And it's often where they build their business, where they bought their real estate, etc. And so it's a thing. But one of our first conversations, often kind of the differentiator in conversation early on, besides the liquidity question that we have, is, well, what are we doing internationally? And they'll be like, well, we've done some ETFs, in Asia or Europe. And I'm like, well, where are they listed? And they're like listed on the New York Stock Exchange. So they're a US dollar asset in the US market. And so I'm like, no, that doesn't work. We need to own assets that are denominated in other currencies. And so I would say the idea of harnessing ideas unconstrained globally is another major differential in terms of how we approach investing and we manage portfolios. And then that leads to the currency question, because you can't do any of these things without having to think about the currency, where you start and where you're going to be going towards. And so, again, we analyze, again, for that geopolitical layer, what are some nations that have stronger currencies? Why do they have stronger currencies consistently? And so, again, as we're running up against time, I will highlight a couple that we like, which is Switzerland and the Swiss franc and the Singapore dollar in Singapore. And these are smaller countries that rely really on capital inflow. So they are seeking different outcomes than pretty much all the large economies, because the large economies are trying to roll debt and debase their currencies gradually. And these are trying to achieve the opposite of that. And so when you take two opposites against each other, there's a real bounce up in the harder currency. And so that's why we think of currency as an asset class. For me, it's not just something that you have sitting idle, which is often, when our clients first come to us, like, we don't want to be 30% in cash. We want to be deploying. We want it to be working for us. And I'm like, well, I want optionality. I want flexibility. The most liquid thing I can have is cash, but it doesn't mean I don't get a yield from it in a risk-adjusted way. But also, I'm using these currencies to buy assets denominated in those. And so my best currency diversification is not sitting in the cash, it's sitting in the equities listed in Switzerland or listed in Singapore, where I now get to hold that currency because that's what I'm going to get when I sell it. And I'm going to ideally get some income distributions while we hold it in terms of dividends. And now I'm getting hard currency back into a client who are maybe spending a softer or weaker currency like the US dollar. And so I win on the currency. I can win on the price of the company that we've done our work on. And if I'm getting a dividend while doing it, I get cash again while we're holding it. Or I can roll it back in and compound it, which can be very powerful. And so, like, just to use like the Swiss franc, like the US has been in its primacy probably for the last 70 years, and the last 20 years kind of been a softening. And I think some would argue that we are really kind of escalating down. I think it's more of a stare down than elevator down. But like, if you look at the Swiss franc, last year was obviously a pretty horrendous year for the US dollar, even against things like the euro, which is, I think you were down around 14%, 13%, just in the currency flip. And so, like, if you think the S&P 500 was up 14% in US dollar terms, in truth, you had no return if you factor in the underlying debasement of the currency. So you take in risk with no return. I don't think many US investors, when we first talk about that, has that front of mind. But like, the last year was a unique year. I think like the Swiss franc was at its highest level, or the US dollar was at its lowest level, if you'd like, since like 1700s and something, like basically when the US 1798, I think someone did the sort of backtracking on some of that. And it just shows you, like, being in one currency, whether it's the US dollar, I mean, the British pound also had a pretty horrendous year last year, and the euros had its issues. And so we think long term, most of the major currencies will be debased, probably more stairs down than elevator down.
It's wild because I've been hearing stories too about how, people are going to their advisors about this and raising the flag, and they've raised the flag, even almost like years ago, let alone months ago and years ago. And the advisor is like, oh, as if they have their long-term thinking cap on, being like, no, it's going to settle. It's going to settle. Like, we're going to be, and so what you're saying right now is very much, that is not what you're saying.
No, and again, back to the reaction, I don't think people should be like, sell everything tomorrow and just blindly cross over. And so again, for a lot of our time, when we have a mandate to go more global, the first question that our investment team then deals with is, we got a lot of US dollars right here, and when can we find some exit points into some of these harder currencies where we're not giving up as much? So you're then waiting in a thoughtful way to deploy, to shift to currency, and then from the currency you can start buying these assets that we actually really want to be holding, which is generally equity participation, which is maybe the last point, again, back to my liquid preference. We also have a preference for equity versus credit. Credit, you're a lender. I'm not super interested in being a lender. It has a lot of risk attached to it, and the upside is more limited. And we again have this idea that entrepreneurs and business building solves problems long term. And so the idea of being directionally long alongside human ingenuity over the long term has been a winning formula. And it doesn't mean we don't do credit. We will do credit for some income in some format, and sometimes for impact. Credit is much more traceable, so municipal bonds, etc., can be interesting from an impact perspective while giving you some yield. But our starting point is equity, and specifically public equity, versus pretty much any assets. And maybe just to round out, the other way to do the debasement of the currency is the real assets. And for us, real assets, again, the best ones in our view in terms of as an allocation tool are the liquid ones, which is primarily physical gold held in Zurich, Switzerland, with a liquid gold market attached to it. So I own the actual gold, and I can liquidate the actual gold with very low friction. The other one has increasingly become Bitcoin. Bitcoin have the mathematical framing of physical gold. It is a scarce asset inherently, and it is liquid 365 days a year, and now at sort of levels where you can move large holdings in and out of it. And so outside of that is things like, real proper real estate with no leverage in enduring places. I mentioned my friend with the farmland and forest land in New Zealand. art, big fan. But, those are illiquid real assets. And again, they have a role within the toolbox of a total portfolio. But again, you got to size them appropriately, and specifically the ones that are illiquid.
All right, I'm going to keep going. Actually, I have 2 more questions, and if I get kicked out of this room, then we're going to wrap it. But I want to try to squeeze in 2 more questions. People are coming to you with real estate. I mean, how are we looking at that?
Positively. I mean, again, having a nice home. Back to what is the really important thing. Like, we've talked a lot about the wealth here, but true wealth is the time you have specifically with people who matter to you and a community that matters to you. You can't make more of that time. You can make more money ideally if you have a good asset manager. Reach out if you don't. But so I think where the real estate often starts for most families is the home. And absolutely, you should do that. I don't think you should be using leverage if you have generational wealth. And ideally, you're buying a home that maybe becomes the home of your children or becomes some important piece of whatever that is. So net, love real estate. Again, there's obviously timing, market, leverage, all of these things. It's a broadly real estate market in the shorter cycles is credit driven. So again, depending on interest rate, etc. So you want to be thinking, you want to be thoughtful about acquisition of it. But again, it's on one of those things that a lot of our clients want to build and hold long-term a portfolio of, often in different geographies. And so you actually get currency diversification, whether you're renting it out in that currency or not. So like Swiss real estate can be a beautiful thing. It
Oh,
takes a little bit
very
of doing.
interesting. Oh,
So you can think of it like a real asset. You can think of it again as an enduring asset. Again, it is illiquid to the sense that I'm relying on some other person falling in love with that piece of real estate at that particular moment in time and us meeting a price. So again, it needs to be sized appropriately. But yeah, we like real estate for the real asset piece. I love real estate for it being a gathering space for family or somewhere you raise your children or something that has like a unique, it's one of those assets you can actually be inside. Is not much fun to own some shares. I mean, it's great, but you don't get to, if the forest, I can go for a walk in it, the home I can have my children in. And those are qualities that I think you should be considering. So that's real estate for you high level. Again, there's specifics and different ways you can go about it. But that's how I think about it.
Okay. And then can you talk about why the bespoke approach particularly helps endowments and foundations when it comes to providing structure and liquidity? Because I think that it's actually the approach to endowments, and I know we help endowments, is actually similar to how we approach with a family.
Yeah. And again, I think it starts where we began this conversation. Endowment have forever time horizons, ideally. And they need some cash flow every year to support what they're doing. But again, just like with a family's wealth, you don't want to be eating the seed corn to have those outcomes. And so ideally you find a way to protect, compound, generate organic, sustainable cash flow that can be used for good things. And so our approach is pretty much the same. And then, as I said, I think that when I hear the problems, if I close my eyes and I'm not sitting in an investment committee meeting at a foundation or something, I'm sitting in a family meeting, this thorn in the shoe is kind of the same.
It's similar.
It's the liquidity, it's the no diversification of currency at a time when that's pretty important. And so I would say that they're very similar in what you're actually doing. Actually, in some ways, the endowment is somewhat easier because I don't have the tax consequence to making changes that I do in the private side of someone's portfolio. And so similar kind of stories, unfortunately, on the negative, but on the positive, and in terms of the scope of the work and what is really interesting is the same things.
Yeah, similar opportunities.
Yeah. And it's also an advisory role. Many smaller endowments, they don't have a full investment committee of, 100 full-hour, full-time professionals. And so when we work, it's often not just us managing a certain strategy within a portfolio. It's also the advisory and the support in terms of trying to make informed decisions, just like it is with a family. So there's 2 pieces to it, advisory and management in most cases.
Okay. My last question for you, Sune, and then I'll let you go, is more of a practical one. Correct me if I'm wrong, but I believe our minimum asset is $5 million.
Our minimum. So again, we serve different types of clients. What we've been talking about here today is sort of total wealth within a family office piece. So that will be under what we call advisory as a core mandate. But we do manage specific strategies. So if someone said, look, I already allocated, but I really like this idea of not having US dollar, or I really want to lean into a Swiss portfolio, or whatever it might be, we can build that for you. And that minimum generally starts at $5 million. And within that, they get support initially, and they get kind of a tailored strategy still. And generally, we open up a bank account with one of our selected custodians around the world that again can be a value add specifically with clients who want Swiss banking, for example, is very popular. Clients want to hold assets, not just the currency in a non-US country or non-USD country. Some people want to have a plan B, or they just generally want to spread their eggs out a little bit wider in terms of the baskets. And so, the Swiss bank account is often sort of the nest egg for families. And so we have relationships there, and we can open up accounts. And so normally it's an account plus an allocation strategy. And also we have some clients where that's where they start the relationship, and then they get more comfortable with us, our model, and then we start talking about, stones in the
Yeah.
shoe and more
Yeah, and the
service.
relationship can grow. I just wanted to highlight, for anyone who's listening, and everyone's position is different, and Bespoke can serve those with 5 million and all the way to 500 million, 900 million, and those solutions are obviously incredibly different.
Yeah, I think the family office becomes relevant, where we would say the lower end of that is, and a family office means many things, which we could do a whole other podcast on, but
We
like,
have an
yeah,
episode on it.
I'm sure we do. You should check it out if you're listening to this one. But I would just say, like, there are early stage founders, for example, where they come, like, the people associate family office with like multiple yachts and planes and like, and maybe you're like, no, a family office essentially is just an organizing principle and some kind of team operational system for your wealth. And you may not need 100 people and 10 different trusts. You may just need 2 or 3 things and some advice while you go back and build your business. And ideally, you move up. And I would say, 100 million plus is kind of where we start leaning in the full services for most of our clients. And then it depends a little bit on what states of life the family is at. If there's a single individual, it's a little bit less complex in some ways. Then again, depending on their asset mix when they come with us, if it's all tied up in their foundational business, it's a different role we have, but we can certainly help there as well.
Okay. Well, thank you, Sune. As always, it's been a pleasure. I think that it's been, we've explored how we're doing things differently in terms of, Bespoke being a trusted partner and long-term building and a lot more. So thank you to everyone who joined us today. And thank you, Sune. And we'll see you next time.
Thank you, Claire, and everyone who listened to the whole thing here.